Alarm bells in the commercial real estate sector for regional banks. Hi, everyone, and welcome to Ainsley Insights, brought to you by Ainsley Bullion, Ainsley Crypto, and the Gold and Silver Standard as the Ainsley Group celebrates 50 years. Today, we welcome back Branko, who's back on the topic he nailed this time last year, commercial real estate and the impact on regional banks. Something he loves to talk about, something he's been following very closely. How are you going today, Branko?
Yeah, good, Chris. Keen to talk about today's topic, which we kind of always touch on, but I think it was in the news this week, so I thought we'd have a closer look. Ties into last week as well.
Absolutely. And I think what's so important about this is, particularly in your case, where you've been following this and keep bringing it back to us, it hasn't improved, right? So what I think is really important here is it was something that people were heavily focused on back when we saw Silicon Valley Bank back last year. We talked about it a lot at the time. Then everyone kind of forgot about it, but really nothing improved. And that was the big issue. Nothing had actually been fixed. Nothing had actually improved. And we find ourselves here today back at, it appears to be back almost at crisis point again. So can you maybe start off by telling us what's going on and where we're at today?
Yeah, so I'll just talk a bit about the commercial real estate loans. This is kind of a big topic right now, and the health of the banks that are kind of in possible financial stress at the moment. So you have big banks right now, which we discussed last week, that are performing even better than before. And we saw last week they had this arbitrage play on the bank term funding program that they made billions of dollars off of. And now we have a similar thing that's coming at the expense of smaller banks, where you have these commercial real estate loans which have dipped over 10% the past 2 years, right? And in general, smaller regional banks, a larger portion of their asset base is attributed to these loans, right? 30% compared to only 7% for large banks. So the past 2 years that these loans have been kind of going down and a lot of bad debts have come in.
Yep.
The small banks are struggling. And now we're basically
sorry,
seeing,
just to clarify that point, is that because a lot of them are based in those local communities and that's the logical place you would go to for a loan? Is that because I think you've talked about that before?
yeah. Generally, this is the kind of loan that regional banks get, like when they're in their community, like small business loans, things like that as well.
Yeah.
And so basically, they've felt the brunt of this CRE decrease, and now big banks are swooping in with the kind of low valuations and making all the money, and the small banks have all these bad assets on their books. So it's just a bit of a warning sign at the moment. I think we did see we actually saw a mid-sized bank, New York Community Bank Corp, like yesterday, have some troubles as well. So this could start to, could we see some banks start to struggle with this and a similar contagion effect? I think it's possible.
And that one, that Bancorp Bank, they were holding some of the Silicon Valley assets from memory. Is that correct?
Yeah, I think so. Yeah. So that,
Yeah.
a lot of this does tie back to SVB, which
It's still that flow on effect that you have where things weren't actually resolved. They were just sort of pushed somewhere else.
yeah, kind of similar to like, sorry, we go back to crypto, but FTX, when they went down, it took months and months and months and months, because everyone's unwinding their assets. So
Yeah.
even now, SVB's effect is pronounced, and who knows? Maybe there'll be another SVB in the future.
Well, and it feels like we might be closer to one. So if you talk about in the article as well, lending standards, can you maybe just give us a bit more detail about what you mean there and how lending standards play into this situation that seems to be unfolding?
Yeah. So basically, I'll put up a graph as well of what's happening with the lending standards, and pretty clearly, you have small banks tightening lending standards significantly, which generally means kind of a lack of capital and potentially financial distress, because generally as a bank, obviously you want to give out as many loans as possible to earn interest, right? So probably not a good health sign that they're reducing them. But then kind of even more alarmingly, you have big banks just like basically saying, we're not tightening these. Anyone can get a loan right now. They're loosening them. So, which in 2008, we obviously saw to an extreme degree, which hopefully we don't see again, where they're giving out those ninja loans, no job, no asset, no income, I think.
Yeah.
And so just kind of alarm bells there in terms of like small banks are clearly under duress, and then big banks are doing very well, and they're like, we're open for business. let's absolutely slash all these lending requirements. So definitely something to follow, and kind of ties into this idea again of big banks coming in to swoop in on these CRE loans, because generally the lending standards on CRE loans are actually different to a lot of other loans. So that's probably why they're slashing them as well, to get more of these type of loans in.
And this tale of two banks, where you've got the big banks and small banks operating very differently at two ends of the spectrum here, is probably got a lot to do with the big banks expecting to be bailed out, right? Like expecting that they're too big to fail. Ultimately, they can take this risk on their books. The small banks can't do that, because we have seen already that they don't get bailed out. And I think what was most concerning, and I'd love for you to talk about this, is what Powell came out and was saying, because that he did that 60 Minutes interview, and it just blew me away, some of what he was saying, in terms of, historically, you wouldn't expect the Fed chair to be, first of all, making an interview like that, sort of so mainstream and so public. And then what he said, I thought was kind of crazy. So can you give us a little bit of background there, what he said, and if we should be worried about it? I certainly am.
Yeah, I think, you could talk more about some of the other stuff he said regarding rates, but in terms of the commercial real estate market, I'll just read a couple of quotes. I think they're pretty alarming. He said, "There's some smaller and regional banks that have concentrated exposures in these areas that are challenged, and that there will be expected losses. It's a sizable problem." He also said that. "I don't think there's much of a risk of repeat of 2008. Okay, that's good. I also think, we need to be careful about making proclamations about the future." So there he absolutely just hedged his position there. He's like, it's not 2008, but also I don't know anything. So a bit of a worry. And then last kind of alarming one was, there will certainly be some banks that have to be closed or merged out of existence because of this. That'll be smaller banks, I suspect. So not
Insane.
great comments by Powell, and yeah, very alarming. Surprised it didn't get more coverage. And then obviously stuff about the rates as well, where he basically said, backed them into a corner, they're not going to raise rates. So,
And that's what I don't understand, right? You've got this situation where he's effectively gone very publicly saying we're not cutting rates soon. Like, he's not saying he's not cutting rates this year, but not cutting them soon. So back up there on your expectations. At the same time, we're not bailing out these banks, and we absolutely expect to lose a whole lot of smaller banks. What does he think is going to happen in that scenario? Because as we know last time, the moment that you started to see one bank fail, everyone's attention turned to the other regional banks and they started selling. So whether they were healthy or not, everyone starts selling because they're worried about contagion in that area. And it's a self-fulfilling prophecy. You just end up with a massive collapse there. So ultimately, if that happens, they're going to have to come back in and do something about it. So that's fascinating to me. Why would you go immediately before that and say, we're not going to do anything, when he knows very well that probably his actions of saying he's not going to do anything is going to cause the problem in the first place? Pretty crazy stuff.
and a part of me is kind of scared that maybe they've been in a situation where they have to do something, but what if like the egos of these people get in the way, and
Yeah.
because it's said they can't, now they just have to stand by their word, even though it's a poor decision. So it is kind of a very scary time, and if these banks start falling, and rates increase, I mean, geez, it's just going to be chaos.
And what do you see in terms of contagion there? Because I suppose that's one area. Last time we were worried about the contagion, it didn't really spread. It was pretty well contained, but it was contained because they brought in that bank term funding program. They basically just plugged the hole and kicked the can down the road. So do you see potential contagion this time on the back of what you've just said about what we're hearing from people in very senior positions like Powell?
And on the back of BFTP ending as well in March, so that lifeline isn't going to be there anymore that was being abused, but still it was a lifeline for some small banks. So the fact that that's not there, and then also I remember we had the Credit Suisse as well, and they got bought out by UBS, / the government / the Fed. So is that going to happen again? Like, I think all the factors are making it out to be that it's going to be, potentially a lot, a decent amount of banks could go under because they don't have the safety valves they've probably had in the past. And I mean, especially if the Fed's going to act this way, it's not looking too good.
No, So you do see the potential contagion could be much broader than just that banking sector.
Yeah, because also I think, you know, well, within the banking sector itself, but another key point would be like, we already had the SVB collapse, so they bailed them out. I mean, I think it's optically difficult to just like a year later just keep bailing out unless they want to start a whole new program with like a different term.
Yeah.
But I think optically it's difficult to end the program and then start it back up again to save banks or
But is
bail
it
out.
optically, I completely agree with you, but is it optically difficult as well to have these banks collapsing? And I mean, that's the
Yeah.
fear image. That's the image on your screen with people lined up outside banks trying to get deposits out and worried if they can, and people losing their jobs. I mean, it's pretty powerful imagery.
Maybe I think the only thing that could save it is the fact that it is an election year. And I think you could argue that the Biden government obviously would want to maintain economic stability. So in the event we do get some craziness go on, they're going to be incentivized to come in and save it. But the mechanics around how they're going to do that just seems difficult because again, you've got the program ending and you've got these small banks just struggling like crazy. So yeah.
So we might have to keep our eyes open for another 4-letter acronym because no doubt there'll be one just around the corner by the sounds of that.
For sure, by the looks of it.
Well, Branko, thank you so much for that. Another area we'll be paying attention on, but you have been for a long time, so I'm sure you'll keep us up to date as it unfolds. So thank you.
No worries. Thanks, Chris.
Thanks everyone for watching. We'll chat again soon.